If you've heard everyone tell you to put money in index funds and thought, okay, great, but which ones? This video's for you. Maybe you've asked yourself, where do I start? Is $5,000 too small? Too late? What if I pick the wrong one and it underperforms? What if the experts are wrong and the next decade looks nothing like the last one? In this video, I'll answer every single one of those questions, step by step. What an index fund actually is, how to pick one without guessing, how John builds a real portfolio with $5,000, exactly how to buy it today, and in the end, I'll show you two things. How John turns that $5,000 into more than $262,000 with 3 Fidelity index funds and 0 contributions after day one, and 2, a more aggressive version where a simple change to that same portfolio pushes the same $5,000 past $733,000. But before John builds anything, he needs to understand where his money's actually going to live, because every dollar in a brokerage account ends up in one of 3 places: a stock, an ETF, or a mutual fund. And the difference between them matters more than most beginners realize. Look, a stock is ownership in one company. That's it. So if John buys Boeing, and Boeing has a brutal few years, which it did right through the 2020 pandemic, he feels every drop of it. One company, his entire investment riding on whether that company has a good decade. Obviously, the upside is bigger if he picks right. The downside is just as steep if he doesn't. Most people don't pick right consistently, and the ones who do, most of them actually got lucky. Now, an ETF is different. ETF stands for Exchange Traded Fund. It's a basket of stocks bundled into one purchase. Hundreds, sometimes thousands of companies inside a single ticker. John buys one share of an ETF and he basically owns a slice of every company inside of it. If one of them has a terrible year, well, the rest can carry it. And nobody's managing the basket. It just tracks an index. Whatever the index does, the ETF does. And that simplicity shows up in the overall cost. ETFs typically charge between 0.03% and 0.3% per year. Now here's the thing, a mutual fund is also a basket. Same idea as an ETF. The difference is how John buys it. ETFs trade on the stock market like a stock would all day long. Mutual funds, however, settle once a day at the end-of-day price, bought directly from the fund company. And mutual funds come in 2 flavors. There's actively managed mutual funds, where somebody's picking the stocks and charging John roughly 0.5% to 1.5% a year for the privilege. And index mutual funds, which are different. Same idea as an ETF, just a different shape. No manager, no stock picking, it just tracks an index and the lower cost reflects that. Some of the index mutual funds in this video actually charge basically 0. Okay, so where does John land with all of this? Well, he's not going to pick single stocks. There's too much risk on too few companies. He's also not going to pick actively managed mutual funds either. He's picking index mutual funds, same engine as the ETFs he could buy. All things considered, that's so much easier to operate as a beginner. Now, there's one cost number, the expense ratio, that John checks first before buying any fund. Every fund in this video has an expense ratio under 0.3%, with one exception that earns its place, which we'll talk about later on. The expense ratio is the first filter John uses. And there are 2 more things John checks before putting a single dollar in. They're just as important. The second is what the fund actually tracks. 2 funds can both call themselves index funds and own completely different things. One might hold the 500 biggest U.S. companies. Another might hold 3,000. Another might concentrate entirely on a single sector. The third thing John looks at is the minimum investment. This is where mutual funds get tricky in a way ETFs never do. Some mutual funds gate their best share classes behind real money. Vanguard's Admiral shares, for example, the cheapest version of every Vanguard fund, requires a $3,000 minimum per fund. That means a 3-fund Vanguard portfolio is locked behind $9,000. For a beginner with only $5,000, that's an entire fund family John can't touch. Fidelity's index funds work differently. 0 minimum on every fund in this video. So whether John has $50 or $50,000, the door is open to him. So now we have 3 filters: expense ratios less than 0.3%. We know what the fund tracks, no minimum standing between John and the fund. Every fund in the portfolio clears all 3. So let's get into the build. This starter portfolio is built around 3 index funds, each one chosen deliberately, each one with a specific job inside the portfolio. Before we get to how John split his $5,000 across them, let's talk about what each fund actually is and why it belongs here. The first fund holds 500 companies. That is FXAIX, the Fidelity 500 Index Fund. It tracks the S&P 500, an index of the 500 largest publicly traded companies in the United States: Apple, Microsoft, Nvidia, Amazon, Berkshire Hathaway, and 495 others. When John buys FXAIX, he owns a slice of all of them at once. The index is weighted by market capitalization, so when the biggest companies grow, the fund grows with them. And when a smaller company in the index has a rough year, it barely moves the needle because it's such a tiny piece of the total. Expense ratio, 0.02%, basically free. Dividend yield, 1.06%. Average annual share price appreciation, 13.57%. FXAIX clears every filter without breaking a sweat. The lowest cost in the video, the most trusted index in the world, holdings that have survived the dot-com crash, the 2008 financial crisis, and the 2020 pandemic, and recovered from every single one. FXAIX's job in this portfolio is stability. It's the part of the portfolio John doesn't have to think about at all. The second fund is FNCMX, the Fidelity NASDAQ Composite Index Fund. FNCMX tracks the NASDAQ Composite, which is roughly 3,000 companies heavily weighted toward technology and growth. Apple, Microsoft, Nvidia, Amazon, Alphabet, all sitting near the top. Technology makes up half the fund. Consumer and communication services fill in the rest. The difference between FNCMX and FXAIX is concentration. The S&P 500 spreads across every sector: financials, healthcare, energy, utilities, technology, you name it. Meanwhile, the NASDAQ Composite leans hard into companies building the future. And historically, that concentration is exactly why the NASDAQ has outpaced the S&P 500 over long time frames. That said, it's also why it drops harder when technology has a bad year. Expense ratio, 0.29%, higher than FXAIX and on the higher end of the 0.3% filter. It's worth the trade, though, for what it adds to the portfolio. Dividend yield, 0.46%. Average annual share price appreciation, 18.25%, the highest of the 3 starter funds. FNCMX's job in this portfolio is simple: growth. It's what pushes John's long-term number past what the S&P 500 alone delivers. Okay, so most beginner portfolios stop at America. John's doesn't. The third fund is FTIHX, the Fidelity Total International Index Fund. FTIHX tracks more than 5,000 companies outside the United States, across developed and emerging markets: Germany, Japan, South Korea, the United Kingdom, India, Brazil, Switzerland, every meaningful economy outside America bundled into a single fund. International stocks don't always move in the same direction as U.S. stocks. When American markets struggle, and they will in cycles, international markets sometimes hold steady or grow independently. That's geographic diversification. John's portfolio isn't tied entirely to America having a good decade, and in a 30-year window, there will almost certainly be stretches where America is not performing well. Expense ratio, 0.06%. Dividend yield, 2.52%, the highest in the portfolio. Average annual share price appreciation, 6.07%, the lowest. FTIHX isn't the growth engine. At a small allocation, it won't drag the overall return, but it covers something neither of the other two can: the rest of the world at basically no cost. Listen, the US market has led the world for the past decade, but it won't always. FTIHX makes sure John is covered either way. So FTIHX's job in this portfolio is balance. So there you have it, 3 funds, 3 jobs. Here's how John splits his $5,000 across them. Half goes into FXAIX, $2,500, because that's where the stability lives. The other 2 funds can take more risk, because this one doesn't have to. FNCMX gets 30%, $1,500, enough to meaningfully push the long-term return above what FXAIX alone delivers without making the whole portfolio rise and fall with the NASDAQ every quarter. And FTIHX gets the remaining 20%, $1,000. Not a token allocation, a real position that adds geographic coverage without diluting the growth story that FXAIX and FNCMX are building together. John's total investment is $5,000, one time, nothing added after day 1. Across the 3 funds, the starter portfolio blends out to a 1.17% dividend yield, an 8.89% dividend growth rate, and an average annual share price appreciation of 13.47%. And that last number is what does the heavy lifting over 30 years. Now, in a couple of minutes, I'll show you how this starter portfolio grows to over $262,000 from John's one-time $5,000 deposit. Then, I'll show you a more aggressive version where a simple change pushes that same $5,000 past $733,000. But first, let's actually get John's money into the market. John has a plan for his portfolio, but now he needs to actually buy it. And here's where most beginners get stuck. Not on the steps are easy, they get stuck on hitting the button. Because picking the funds is one thing, actually moving the money is another. So let's get John through it quickly. 3 steps, that's all it takes. The first step is opening a brokerage account. This is where John's funds will live. Think of it like a bank account, but instead of holding cash, it holds investments. For everything in this video, John needs a Fidelity account specifically because every fund here is a Fidelity index fund. Free to open, no account minimums, no monthly fees, and the process takes about 10 minutes online. Name, address, social security number, and bank account to link. That's everything required. The second step is funding the account. John transfers $5,000 from his bank account into his new brokerage account. Most brokerages process the transfer in 1 to 3 business days. The money doesn't need to be invested immediately, it sits as cash until John is ready to buy. Quick note, one thing worth doing before buying anything, turn on automatic dividend reinvestment. It's usually a single toggle in account settings. When dividends are paid out, and every fund in this portfolio pays them, instead of sitting as cash, they automatically buy more shares, which is free compounding that starts with the first dividend John receives and never stops so long as John keeps reinvesting. Turn it on once and forget it. The third step is buying the funds. John searches the ticker, FXAIX, FNCMX, FTIHX. Then he types in the dollar amount, $2,500 of FXAIX, $1,500 of FNCMX, $1,000 of FTIHX. Confirms the order, done. The fund settles at the end of day price. That's the entire buying process. No special knowledge, no financial advisor sitting across a desk. If you and John can order something online, you both can easily buy an index fund. It's that simple. Okay, so the money's in the funds. Now what? This is where most people sabotage themselves without ever realizing it. John's brain is going to want to do something. It's going to want to check the account before bed, read every news headline about the market, move money around when one fund is up and another is down. That itch to manage the portfolio is the single biggest reason most beginners underperform the funds they're invested in. So here's John's plan for the next 30 years. He doesn't manage anything. There are 3 strict rules he's going to live by so he can maximize his investment. Rule 1: when the portfolio drops, John doesn't touch it. The market is gonna fall, not someday, repeatedly. Bad year here, recession there. A 20% or 30% drop is normal. It happens roughly every decade. The people who actually lost money in those years weren't the ones who got unlucky, they were the ones who panicked and sold near the bottom. John doesn't sell. He waits. The market has recovered from every drop in its history, and he has 30 years. Rule 2: the dividends keep buying more shares automatically. John already turned this on before his first purchase, so every time FXAIX, FNCMX, and FTIHX pay him dividends, which they do every quarter, that cash doesn't just sit there. It buys more shares of each fund. The more shares he owns, the more dividends he collects next time. The more dividends he collects, the more shares he buys. That snowball runs in the background for 30 years without him doing a single thing. Rule 3: once a year, John takes a look at the portfolio. Not weekly, not monthly, once a year. He opens his Fidelity app, sees what each fund is doing inside the portfolio, and checks one thing. Has anything drifted too far from where it started? Maybe FNCMX had a huge year and now it's 42% of the portfolio instead of 30%? If yes, John rebalances to the original plan, sells a slice of what's gotten too big, buys a slice of what's gotten too small, and puts the allocation back to where it was supposed to be. If nothing's really shifted, John just closes the app and gets on with his life. That's it. One annual check, one rebalance if needed, otherwise, hands off. Now, here's what future projections look like when John follows these steps. John put $5,000 in on day 1 and never added another dollar. Everything you're about to see is just that single $5,000 doing its work. Year 1, the portfolio is projected to sit at around $5,732. He's up $732. And to a lot of beginners, that feels underwhelming. Here's the thing, year 1 always looks small. Compounding hasn't had time to do anything yet. What matters in year 1 isn't the number. It's that the clock has started. Year 10, the account would grow to roughly $19,241. John still hasn't touched it, and the original $5,000 is now closing in on $20,000, almost 4 times where it started. This is when compounding starts pulling its weight. Year 20, the portfolio is projected to reach about $71,757. John's in the middle of his career now, probably barely thinking about that one deposit he made 20 years ago. But that one deposit is now sitting at over $70,000. And here's the part that sneaks up on people. The same $5,000 took 10 years to become $19,241. The next 10 years? It became $71,757. So decade 2 added roughly $52,000, almost 4 times what the first decade added. The growth keeps getting bigger every decade. Finally, at year 30, the projections show $262,409, over $250,000 from a $5,000 deposit. Of that $262,409, John only contributed $5,000. The other $257,409 came from the market. Most of that, $249,467,000, is straight capital appreciation. The portfolio grew because the companies inside it grew. The remaining $7,942 came from reinvested dividends, the drip toggle John flipped on before he bought his first share. Now, what if John doesn't want safe? What if $250,000 over 30 years sounds fine, but it's not exciting enough? Okay, John, then we change one thing in the portfolio, just one, and the year 30 number stops looking like $262,000 and starts looking like something a lot bigger. This is what I call the aggressive growth version. It's the same $5,000, same one-time deposit, same 30 years, one different fund in the mix. And the math gets dramatic. But before we get into it, honesty check here. Let's get real. This version isn't for everyone. It's for someone who actually has 30 years to wait, and more importantly, someone who isn't going to panic sell when the portfolio drops 30 or 40% in a single year, because it will. That's the deal. If John can't handle a bad year without touching the account, he should opt with the starter. The starter already has his answer. But if he can stomach the ups and downs, all right, here's the swap. FTIHX is out. FSELX takes its place. Fidelity Select Semiconductors portfolio. And before John gets excited and clicks buy, we need to have a real conversation about this fund, because FSELX breaks two of the three rules John used earlier in this video to pick funds. Rule 1 was expense ratios under 0.3%. Well, FSELX charges 0.6%. That's more than 2 times higher than the cutoff John set for himself. Rule 2 was tracking an index, not having managed funds. FSELX, however, has a manager, an actual person making picks inside the fund. So fair question, why is John even considering this one? Because of what it actually owns. FSELX invests in one industry and one industry only. Semiconductors, the chips that go into every phone, every car, every server, every piece of AI infrastructure being built right now. Around 60 companies, that's it. The companies designing the chips, manufacturing the chips, and building the machines that make the chips possible. And there isn't another fund at this dollar level that gives John focused exposure to that industry. Most semiconductor-focused funds either require huge minimums to get into them, or they don't exist as a mutual fund at all. FSELX is the path a $5,000 beginner can actually take. The numbers tell the rest of the story. The expense ratio we just covered, 0.6%. Dividend yield, 0%. Huh? Chip companies don't pay out. They reinvest everything back into research. Average annual share price appreciation, 24.5%. That's the highest appreciation rate of any fund in this entire video by a wide margin. Now for the part nobody wants to hear. FSELX falls harder than anything else here when the chip cycle retracts. In 2022, it lost about 35% of its value in a single year. In 2008, it lost nearly 50%. Those years happened. They will happen again. And the only investors who came out ahead were the ones who didn't sell when the screen turned red. Remember that. So that's FSELX, the highest growth fund in the video, paired with the highest volatility ride. Built for one job in this portfolio: aggressive growth, concentrated, risky, and worth it if John can stomach the dips. With FSELX in the mix, the allocation shifts. FXAIX drops slightly to 40% now instead of 50%. That's $2,000 going into the S&P 500. Still the anchor of the portfolio. We're just leaving more room for the growth side. FNCMX moves up a bit, 35% instead of 30%. That's $1,750 into the NASDAQ composite. More growth tilt across the broader tech and innovation space. FSELX takes 25%, our new 25% slot. That's $1,250 going into pure semiconductor concentration. Blend the three together and the portfolio comes out to a 0.59% dividend yield, a 5.15% dividend growth rate, and an average annual share price appreciation of 17.94%. That last number is the reason why the year 30 number is about to look very different compared to our starter portfolio. Here's what the portfolio could look like over the long run. Year 1 is projected to come in at $5,927, a slightly stronger start than the starter portfolio. The higher blended appreciation is already pulling ahead in the first 12 months. By year 10, the account would grow to $26,805, while the starter portfolio at the same time was projected to reach $19,241. That's a $7,564 difference from the same $5,000 inside the first decade, and the gap only widens from here. Year 20 is projected to hit $140,623, nearly double what the starter portfolio produces at the same point. 2 decades of concentrated growth and semiconductor exposure compounding, and the distance between the two portfolios is now impossible to ignore. Then, year 30 lands at $733,648. Starter portfolio, $262,409. Again, the aggressive growth portfolio, $733,648. The gap between them is $471,239 from the same $5,000, same person, same one decision, same 30 years. But the numbers don't show what John has to live through to get there. This portfolio drops hard. Some years, FSELX falls 30, 40, or even 50% and pulls the whole portfolio down with it. The $733,648 at year 30 assumes John holds through every one of those drops without selling. Every single one. If you liked seeing how 3 Fidelity funds work together, you'll want to see what happens when only one wins. I ran the numbers on all 94 Fidelity ETFs and ranked every single one, and the answer surprised me. That video is on screen right now.